A couple questions now on naked puts, and we're going to start with the beginning with Octavio. And Octavio's is the open question is can you share some of the tools on PowerOptions to use naked puts? Very similar Octavio. Oh, sorry, let me just down 511. My apologies. Okay. So here we start the naked put discussion. All right. Same thing that we saw with the bull put credit spread. If I want to look for naked put positions, I can go directly into the search tool. We have default searches that are starting point. Covered calls and naked puts have something that none of the other strategies do. You have these weekly picks of the day and the monthly picks of the day. And this is just a quick field that shows you two or three trades that matched our criteria and a discussion below. What this is the top 2 or 3 results. As I mentioned that I use the bull put credit spread. The bull put credit spread weekly is sort of my picks of the day search as well. Ernie did extensive testing on covered calls monthly and weekly, trying about 50 to 70 different variations of at the money, out of the money, high volatility, avoiding earnings, not avoiding earnings, using Bollinger Bands, not using Bollinger Bands, using MACD, not using MACD, so on and so forth and so forth. Probably about 50 to 60 iterations for each search and over several market periods, testing at several market periods, finding which criteria gave the best return over time across various markets. And that's what the picks of the day are. These are the results that match his criteria after all of that detailed research and analysis. If you wanted to go monthly, he's got ones that are out to June, of course, 49, 50 days out in time, the next standard cycle. And then, of course, you have the weekly picks of the day here as well. This is a description of his testing and how he would approach trading off of the picks of the day. But if you want to create your own search, you could just go into the search tool and, oh, sorry, that was from a couple weeks ago. That was from a webinar a couple weeks ago on setting up a high volatility search. I'm not saying it's good or bad. I haven't tested it since we created it. But again, you can start off with any of our default searches, tip sheet, out of the money, monthly, weekly picks of the day. And this will show you the full list rather than just the top 2 to help you do further research and analysis. Same process as we kind of showed before. I get my results. I'll take a look at the company information if I don't know the stock, maybe the profile, any recent headlines that have come out. I'll take a look at the stock chart to make sure it's going in a trend I want for a naked put position. And then, of course, we're going to further research maybe the stock or the option. I want to make sure if there's an ex-dividend date coming up or anything along those lines, but that doesn't affect the naked put as much as a covered call, Octavio. And then, of course, we'll go to the profit and loss chart and we'll run what-if scenarios. What if the stock does fall 5% in the next 10 days? What if it moves up 5% in the next 10 days? Excuse me, folks. Am I comfortable with the expected gain or loss in that scenario? Now, so there's also some default sample searches, and you can search by symbol as well. Once I enter a position, and we're going to do something different here, I'm just going to go to my portfolio. Here's our April 24th positions. It's looking okay. Kraft Heinz, different married put structures. I forget why we were doing that, but okay. It's interesting to see. It was in October 27.5 puts. The stock was at 20. Oh, that's why we were showing a rollout opportunity. My apologies. Okay, but let's put in a naked put on Kraft. Why not? And I'm sorry, short put. So we're going to type in KHC, hit submit, and let's say that okay, let's go out here, and let's say that when the stock breached $30 and went up to as high as 30, 65, 30, 80 the other day, let's say that I decided to sell the 30 put because I was still bullish, the 8th of May 30 put. Let's just keep it at one contract, and let's say I got 65 cents. And we did this on the 29th. Okay. So now in addition to the married puts I have this naked put sitting there, but the stock's fallen is at 29.36. It's going to cost me $1 to buy it back, so I'm looking at a loss of only about 36 cents. Well, as you're tracking any position in the portfolio, Octavio, naked puts or covered calls or credit spreads, as the stock starts to move against you, we can use that Edit More Information button, go to Position Actions and Position Analysis. This gives me a breakdown of my current position, time value left in price, current loss on the position, $42 versus, oh, it's at 107 now, current liquidation. And then you scroll down and you see that we've got some rollout opportunities. So I could buy to close my May 30 put for 107, and I could roll down to say the 28 put or the 29 strike put as well. So it's showing me different rollout opportunities and the new percent naked yield based on midpoint. So let's just take 21 days out. Let's go, yeah, let's just do this one, the 29. It's not much out of the money. So now when you see a rollout opportunity to help you repair the position or profitable, then you can go to simulate trade, and you can see the positions side by side. It's great to see the numbers numerically, but now you can see the rollout opportunities side by side. This isn't much of a profit, but remember, it's better than a 1.4% loss if the stock stays above 29 in the next 7 days from where I am at a loss of 1.4% right now. So that's a really fast review, and I apologize for that, but that's the tools that are available for the naked puts. You can, as always, in any strategy, you can search by symbol, or you can just, I would prefer for covered calls and naked puts, I prefer just to use the option chain if I'm looking one stock at a time. You can use the picks of the day for ideas and as stepping stones, or use the search, use our default criteria that then creates your own search based on your needs, your time frame, your desired return, and more. Earlier today, I had a conversation with a gentleman, new user to PowerOptions, who wasn't seeing the results he wanted. And the reason why is that his expectations were too high. He wanted to do weekly options, but he wanted about a 1.5% return. But he also wanted to be 10% out of the money. Well, you're not going to find many 5-day trades on reasonable, high-quality stocks that are going to have a 1.5% yield for a 5-day trade with a 10% out of the money or 10% to break even. So you still want to be in reasonable expectations with the search criteria that you use. Then once you found the positions, you can further research and analyze the stocks or the options to that more information button. You can use the add remove columns to customize your data table based on what needs that you want. Then start tracking the positions in the portfolio. You can set your alerts in the portfolio. That 1% rule that I use for credit spreads, I might use for my naked puts as well. And when an alert is triggered, it would show you on the portfolio. Okay. And I wanted to follow this up with, and then of course, I'm sorry, as you're in the portfolio, you can view the rollout opportunities when those alerts are hit. I'm sorry. Okay. James, it's not a difficult question. It's related to naked puts. He says, what do you think about selling at the money puts as opposed to selling puts just past the expected moves? Okay, so I think, James, what you're asking is that, let's just look at an option chain here. Nope. Right thought, wrong selection. Okay. So this is a very dumbed down. Let's go into add remove columns here. This is a very dumbed down chain that we were showing last week for just some examples. And I want to, sorry, ladies and gentlemen, I want to reset to default columns. There we go. Okay. So James says, now if I'm at Kraft Heinz here are our puts. There's KHC, stocks at 29.36. So let's go out 15 days. James is saying, what do you think about selling an at the money put right here for 75 cents midpoint, excuse me, versus selling puts beyond the expected move? Meaning if I thought that Kraft would likely go up to $31 or so in the next 14 days, I think you're saying, why not? What's the difference between selling the 31 strike versus the 29? If I'm getting it, selling an at-the-money 29 strike as opposed to thinking that if I expect this movement to go forward, why wouldn't I sell that higher strike there? Okay, and then you have a follow-up to that, James, I'm going to get to in a second. And so my thought on this is that what do we know about one of the 3 core principles I talked about radioactive trading? And that is the, where is it? Oh, please tell me it's not way off to the right. No, it is. Okay. Well, the percent is, okay, that's fine. The at-the-money bell curve, which teaches us what? The best time premium is always at the money. Okay, so sure, in this case, if I sold the 31 strike, I'm getting $1.84. A lot of that is intrinsic value, but still about 1% of it is time premium. Whereas selling the at the money, we know we're going to be at the 2.5, 2.6. We're always going to have the highest time value at the money with the at the money bell curve. And we have lower time value here and here. Why is that important? It's not necessarily important. If you're right more often than you're wrong, James, with what you say your expected moves or your expectations, yes, you're going to be getting $1.84 instead of 71 cents if the stock ends up at 31.20. If you do that consistently, you're right on your projections. I'd say 75% of the time or higher, this is going to be very successful. What if the stock doesn't move? All right, I collect 75 cents for my 29 strike, which is about 2.5% time premium. We collect $1.93 on my 31 strike, which is $1.64 in the money. So we'll call it $1.63. So this is only 30 cents of time premium. If the stock doesn't move, I either have to buy stock at 31 that's trading at 29 or pay the intrinsic, well, okay, let's say it stays right at 29.36. I apologize. Pay that intrinsic $1.64 to buy to close it, so I only made 30 cents. Here I make more than double. If the name of the game is collecting time premium, I would feel more comfortable, not advising, that's a terrible word, I'd feel more comfortable looking at the at-the-money structure because it has the highest time value. But again, in my structure with naked puts, I prefer to be slightly out of the money, still keeping that at-the-money bell curve in place, okay? And Sam adds a comment to that. You don't know if it's going to go up or not. We may have another 10% sell-off with the virus fears. As many people aren't at work, some things are starting to opening. Restaurants are closing as well, okay? And okay, so now, but selling the put out of the money, what's the, that's the preferred way to do it, okay, is I still want a good time value. And look at this here, like, oh, sorry, that's the yield, but yeah, also the percentage time value. The 27.50, it's not quite 2% out of the money. It's pretty close, but it's about 1.5, 2% out of the money. I'm sorry, it's not 10% out of the money is what I was trying to say. It's about 6% out of the money. It's right here. So it's not quite 10%. But you're still getting a 30-cent time premium for 14 days, which is 1% yield. I think that is a reasonable, and this related to that other conversation I had this morning with a gentleman who's looking at weekly options and wanted a 1.5% yield being 10% out of the money. You don't see it on a 5-day trade. I don't see it on a 14-day trade. However, a good expectation, I think, for a 14-day trade is a 1% yield with a reasonable enough range out of the money. Yes, I can get higher at the money, but you're taking a 50-50 shot that it's going to expire worthless. And as Sam mentioned, with an uncertain market, maybe it's better to be a little bit safe. And 1% yield every 2 weeks, which my expectation is around 0.4 or 0.5% on a weekly option that's just 5 days out. A weekly naked put, James, that's 5 days out. So 0.4, 0.5% yield, that's where we started. But we were only going 2 or 3% out of the money. Because if I go 6 or 8% out of the money, something only has 5 days left, the yield's around 0.3, and the premium's about 2 cents. Okay, that's too far. You have to give and take. If you're going only 1 week out, you're probably going to be in the 3 or 4% out of the money range, still looking at only maybe a 6 or 7 cent net credit, but that's what you're looking for, a 0.5 or 0.6% yield. Okay, and for 2 weeks out, I'm looking at maybe a 1% yield on the naked put position as well. Okay, to a follow-up, you said I sold a put on Apple, AAL, oh sorry, we talked about this last week, AAL March 20, and was put the stock shortly after. Now I'm down about 926. Is it safe to sell calls against this to try to get even, or is there a better way to do this? Great. So you had a position that fell. You got put the stock. You weren't able to manage it because of the quickness of the fall. Now you're down about 926. It got put on the March 20 strike. We saw last week AAL was around $10. I don't know if it's lower right now. We'll find out. Oops. Oh, yeah. So one thing you might consider, James, is instead of just selling, you can sell calls against it, but I thought we covered that risk, is that if I sell the 11 strike call against AAL and the stock suddenly rebounds, volatile movements, new news coming out, a new stimulus comes out to help AAL, what could happen? Well, it could suddenly jump to $12. Now you got to scramble to buy that call or risk getting assigned and locking in a loss of $900 or $800. That's the risk of trying to sell calls against it to get back to break even. But that's where the stock repair tool comes in. So you can put in your symbol and click on stock repair, or you can go into signature tools and access the stock repair. And I thought we covered this, but it doesn't solve the problem of a capped gain, but it might help you get back to break even faster. I'm going to use a cost basis of 10 on 100 shares. Your cost basis might be a little bit lower, might be a little bit higher. You got put at 20, and I think it was around 11. So we're at 10. Oh. So, okay, let's try that. It's probably not going to come up with anything. I'm sorry. So let's say that you had generated a lot of premium with the calls. Let's say your cost base is $11.50. Okay, somewhere around there. All right. Not too shabby. So what is this doing? What this tool did in that instant was to compare and build ratio call spreads. So doing a bull call debit spread combined with selling an extra call. So it looks like a covered call with an extra bull call debit spread. And this is a stock repair position. So what does it do? Well, let's just take a look at the May series. My cost was $11.86. Okay, I know your cost base is probably higher, but my cost was $11.86. Oh, sorry, $11.50. What this shows me is that we could buy one 1050 strike call for 92 cents and sell two May 11 calls for 64 cents, which would give me 36 cents of net credit. That automatically lowers my cost basis down to 11.14, right? All right. But the break even's at 1082, right where the stock is. How is that possible? Well, on May 8th, if the stock is trading at 1082, what happens? My 211 calls expire worthless. I sell to close my 1050 strike for 32 cents. I have a 68-cent loss for my cost basis of 11.50. We keep the 36-cent net credit, sell to close the long call for 32. We're at break even with only needing the stock to be at 1082. And in this case, since I didn't get assigned anything, I could, now that I'm at break even, continue to sell premium. If your cost basis is higher, say at $15, after premium generated for your other naked put trades and then getting put to stock, you still might see some repairs, but they're going to be further out in time. But again, let's go back to 1150. I'm sorry, let's go back to that. What does it look like? Well, again, now I'll go to Analyze Trade here. There we go. I'm going to buy one 1050, sell two 11s. This nothing's naked. It's a ratio call spread, but nothing's naked. It's really a covered call, one of the short 11 strike calls, with a bull call debit spread between the 1050 and the 11 strike. Everything is covered. And you see here, if the stock moves up to these prices, if it's trading right at 11, 50 cents below, I'm going to have a profit of 3.2%. That's the benefit of the stock repair tool as well. And that's another way to help you get back to break even rather than trying to sell lower strike calls continuously and risk getting assigned at a significant loss. Now, of course, if you have a larger cost basis, we saw running it at 15, where only the August strikes came up. But if you have the capital, what you might be able to do is you got assigned at 20, you knock down $4 or $5 from premium, so there's your cost basis of $16 or $15, and the stock's at 1080. If you don't see any repairs and you have capital, what you may want to do is buy another 100 shares at 1080, lowering the cost basis, let's say, down to about, $13.80, $14, not much, but percentage-wise is pretty significant, and then running the stock repair on the lower cost basis after averaging down as well. Some investors say that, look, if you're at this price and you sell the 11 call as a covered call, but you're worried about your cost basis at 15, you might lower the cost basis more by doing what's called a covered combination. It's not a collar, it's a covered combination where you do the covered call and then you sell, let's say, a 9-strike put to get more premium. Now you need the capital for that cash secured put too, and it does double the loss if the stock continues to fall. So you have to make sure you're pretty bullish, whether you're using the stock repair or even it's kind of strange, isn't it? With the stock repair, you want the stock to go back up to get back to break even. Selling a lower strike covered call continuously to get back to break even, you want the stock to stay right where it is. The last thing you want is for the stock to move up, because then you're just rolling and rolling this call and adding to the cost basis, increasing the break even. And of course, naturally, if you do the covered combination I mentioned by selling an extra out of the money put, you definitely don't want the stock to fall in any 3 scenario, but you also don't want the stock to go up, because then you're forcing on even though you collected a little bit of premium, you're trying to work the short call a little bit more. So if your position is that the stock's going to recover and move back up, the stock repair is a better approach, even if it's maybe out to July or August, because you want it to go up. If you're selling covered calls way below your cost basis to repair, you don't want the stock to go up. You want it to stay right where it is so those calls keep expiring worthless and you knock down your cost basis. It's kind of tricky, isn't it? But that's why I suggest the stock repair, because if your anticipation is it's going to rebound, you don't want to necessarily sell calls where you have to continuously buy them back to roll them up, increasing your cost basis and increasing your break even, so you're working harder to get to the break even by selling lower strike calls that are well below your cost basis. More information on this is also, of course, available in the webinar section as always. I want to go to options concepts in this case. Scrolling down here, manage your broken position. Alternative methods for managing a stock position that has moved against you, a covered call position that has moved against you, managing a sold put that is in the M or is in the money, or the stock has been put to you as well. So we discussed the different ideas there, managing those broken positions, focusing on the stock repair tool as well. Something I feel that's a better way to manage it, because your expectation is the stock is going to go back up as well. And let's see here. Isn't that a back ratio? No, James, it's just a ratio call spread, a standard ratio. You're selling 2 and buying 1. Okay, so the stock repair is selling 2 calls and buying 1, which would normally give you a completely different structure with an infinite risk to the upside. But remember, James, you own the stock. So it's a covered call with a bull call debit spread. Nothing's naked. If you can sell vertical spreads in your account, then you can do that too. Pete, let me go back one, because this is a great comment by Pete, but it's also kind of difficult to view in this case. So I still have that custom straddle. I'm sorry, ladies and gentlemen. Let's go back to the, nope, that's not it. Oh, I know where I want to be. I'm sorry. Okay, so let's just go back to our profit and loss chart here. And let me talk about this covered combination. This will cover Pete's comment here for our naked put management and using the naked put tools. About a 25-minute discussion on naked puts. That's sort of a marker for myself when I start cutting the videos. All right, let me clear this out. Okay, so instead of the stock repair. Oh, so that's the stock repair. That's why nothing is naked. There's no extra margin requirement, James. So if you can do vertical spreads, you could just enter a bull call debit spread and then sell a call against your strike. Nothing against your stock, excuse me. Nothing is naked. It is a ratio spread, James, but nothing is naked. You don't have to worry about that. Okay. So cost basis is $11.50. I want to get back to break even. We go out 2 weeks, and you might even have to go out further, but 12 strikes pretty good. So let me sell a 12. Let's see what that would look like. And we talked maybe if your cost basis was higher at 15. But let's cheat and keep with our $11.50 strike, because that's what we used on the repair. It's going to get 63 cents. It's going to drop my cost basis down to $11 there, and we're close to break even. So this isn't bad if that was indeed your cost basis. Now Pete says, can you sell a put? Let's take that off. Can you sell a put to receive premium or get assigned at a lower price to average down? That's what I was talking about with the covered combination, that maybe I'd sell the 12 strike call we'll take that out for now, Pete, and sell the 9-strike put. Okay, now, what's the trick here? There's no real trick, but remember, if you're doing a cash secured put, you have to put up the funds, small price here, but you have to put up the funds to cover it. It's cash secured put, the stock ownership doesn't cover it. That's okay. It's kind of like you're putting in the extra money you would to average down anyway. Now, you're kind of right. You could do this, but it requires extra margin, whereas the ratio spread, the stock repair, doesn't require any extra margin. Break even's at 11.04. With the stock repair, we saw the break even was at about 10.82. Of course, you could sell the 10 strike as well, get a little bit more premium, maybe lower that further, Pete. Now, this is fine. This is another way to do it, and I actually combined it with that 12 strike call in what's called the covered combination. And you're right. So if the stock falls now, I'd average down. But if the stock falls, I'm averaging down, but I'm losing another point, $1.80 on the stock position. I collected 40 cents against it, so now I'm down another $1.40 on the entire position. But now I have 200 shares at 9, combined with my other 200 shares at 11.50, so I lowered the cost basis. But what's the problem here with this, Pete? And this is what I kind of mentioned with the covered combination idea. I've doubled my risk, pretty much close to doubled my risk. So if I'm wrong and this does start a faster fall, the airlines start to get hurt worse with more bad news and no more help from the government. That's this specific example, Pete, not just an overall view. But if that happens, I'm now losing on the naked put and on the stock. And yeah, sure, I can get shares at a lower price if I'm assigned, but now I'm losing much more on my original shares that aren't getting hedged anymore. And I've got another X amount of block of shares at another loss as well. So I'm increasing my risk here in that case. So you have to, again, it is a possibility to repair, Pete, but again, you have to be confident that the stock's going to move back up in price. If the stock doesn't move back up in price, the repair won't help, selling the covered call won't help, and doing it this way can get you hurt as well.